Welcome everybody. My name is Jeff Fowler with the Apartment Owners Association, and it is great to have you with us today. This is the last day of lighting the candles on the menorah, so happy Hanukkah to those of you that are observing that. And what an awesome thought to think of total darkness and to light a candle and to light the whole stand. That's just such strong imagery. Anyway, today we're going to be talking about the 721 UpREIT, 731 UpREITs. Before we get into it, AOA, we've been around for over 40 years. We're the largest individually organized groups of apartment owners here in the state of California. And thank you so much. Many of you are members, and really our goal is to help you make and or keep more money than ever before. And one way that you can do that is just to stay in the know and be caught up on everything and not make mistakes that cost you dearly. And one thing that I wanted to bring up that I just don't know if everyone is aware is that when you run a tenant screening report, when you run the background check, lots of times if you're running only the instant nationwide criminal search, and whether you're doing that through AOA or through other providers, that surge guaranteed, if it's LA County or even half of the counties in California, it is not showing. Basically the court records have redacted the date of birth from those computer searches, and so when you just get an instant criminal, when it's not by hand, it's not going to show you anything, because by law we have to match that enough data pointers with that individual. So with all that being said, run a single county criminal report. You can do that through AOA. And if you're not using AOA, if you're not a member, that's just a good reason to join. Get the single county. They do it by hand. They're able to get the results, confirm the identity, deliver you a report if there's something there. And so just wanted you to know about that. And we recorded a video, and we just posted that to YouTube and everything. And it's California Landlord Tenant Law 2024 Guide. And Mike Brennan, eviction attorney, landlord tenant attorney, he covers this subject very thoroughly, goes into AB 12, SB 567, and many others. And so I want to encourage you to watch that. It's on our YouTube channel. Go to AOA USA on YouTube, and you'll see that is there. Definitely, you need to watch it before the 1st, because there are laws that are taking effect on January 1st that you need to be aware of. And then moving on to the in-person, we have several in-person events in January, so we are starting the year hot. And so Buena Park, Long Beach, Sherman Oaks, we're going to be doing a top tax deductions for housing providers in those different locations. And then also in San Diego, we have a property rights roundtable. That'll be January 10th. So check the schedule for those. The property right roundtable is not up yet, but it will be soon. And then on February 21st, I just want to share this with you, because you are members, and seating is really limited on this February 21st event that's going to be in Santa Clara. And it is the AOA Landlording Power Conference, and it's going to be at the Santa Clara Convention Center. Parking is free. We're providing a lunch for $5, and basically it costs, you can just multiply that many times on what it actually costs us, but we want you to be able to be there from 11 a.m. and stick around till about 4:30, and we're going to have six different seminars all packed into one day. We're saving your gas. Just come down once, but sign up for it, and sign up for that lunch as well, and then that way we'll be able to get a good count on the lunch and get that ready for you. So anyway, that'll be awesome. And so anyway, if you're new to AOA, definitely subscribe to this channel, because just like what we did there with that legislative update for the whole state of California, If you're not subscribed with the notification bell on, then you won't get it. And also, I do want to welcome everybody that's watching from AOAUSA.com and also from Facebook. And you can, if you're on AOAUSA.com with all of this, you can put your questions in where's that blue help bubble, and you can put your question in and they'll funnel that over to me. So that'll be great. But anyway, for today, we just want to thank Real Estate Transition Solutions for sponsoring this event. And they have 3 offices on the West Coast. They do 220 in yearly replacement property. So sizable company here that we're dealing with. And one of the partners at Real Estate Transition Solutions, and a guy that's been in the industry his whole life because his dad is a real estate investor, and a guy that is a CPA and worked with PwC in several capacities there. And this guy is sharp, so it's my pleasure to introduce to you today Austin Bowlin. Take it away.
Right now, the action and to follow your you can do it by terms of just days that the problem education set value for the ownership. Really appreciate this with the habit sale and also regional properties. As mentioned by possible partner transition as wrong. It was how he talked. This is really when studying one change, and it's really that direction. And I into the REIT about the trust. I will not another way in which you can ultimately use hacks for other action or to reownership. We're going to be about structure that allows action that occurs that or to trust. And going to our statutory the cash medicine change as you be and the so I mean necessity and ours, not including all your residents. And overall, when discussing and a quick exchanges, these present and someone who has that knowledge. Then consider very popular to utilize this structure. Also, gas additional and some time for questions throughout course to Azure and our solutions.
Hold on. So we have happening. Start with Henry start okay. Editing you're in out like process. I don't know the difference. All right. Apologies. Apologies, everybody. We had a little technical issue there with Zoom, and so we're going to have Austin rejoin. and that should take just a couple seconds here, and hopefully he'll come back on. So please bear with us. And just as we're waiting for him to come back on, just do want to mention that we did run an article in the December magazine for those of you that are in the LA area, and we have it listed as 7% for the rent increase. And so if you read that before you give the rent increase, definitely reread that article online, and we'll be sending out an email within the next couple, either today or tomorrow, that will have the updated information. It's 4% plus utilities. So just want to make sure you know that. But great, we have Austin back on. And so let's see, let's hope that this works a little better. So apologies to all of you. And I think if you can transition over, or let me know, are we good to transition over now? Let's see.
He's already connected. See.
Okay. Right, so put him, are we going to put him on?
We're going to put him on right now.
Great. All right, Austin's back in. Hopefully we can get this thing going. There we go.
So it's important that it is important where it does education by the engineering is true to we need to topic services and things and our tax and or
Is it I can find it.
Yeah.
With it. Sorry. Well, I don't think it has anything to do with. We just started broadcasting to Rumble live at the same time. Okay, everybody. So we're back. We're live. And this is the problem. We just turned off all of our stuff, got it restarted. So we're just going to pick up where we left off. And so if you could just take us from where you left off there, Austin, then that'll be great. And hopefully everything will work out well.
Okay, perfect. Third time.
You sound good to me. So
Third
time's a charm, right?
We'll cross our fingers and hope that it at least works for the next 30, 40 minutes or so.
Great.
As I was mentioning, today we're going to be discussing a topic that surfaces regularly in our conversations with investment property owners, which is this question of, can I sell my property and perform a tax-deferred 1031 exchange into a real estate investment trust? So we're going to unpack that a little bit today. We're going to talk about how you can use tax-deferred dollars via an investment property sale to ultimately have REIT or real estate investment trust ownership. One of the way to do so is through what's referred to as a Delaware statutory trust, a specific category of Delaware statutory trusts. And it is important to know that in order to invest in a Delaware statutory trust, one must be an accredited investor. So you need to have a net worth in excess of $1 million, or and that excludes your primary residence, or annual income in excess of $200,000 as an individual, $300,000 if you're married filing jointly, or there are a number of professional licenses or certifications that you can also hold in order to be an accredited investor. Here you'll see an overview of what we're going to discuss today. We're going to start with a little bit of 1031 basics just to make sure everyone has that foundational knowledge. Don't want this to be a new term for someone as we dive into further downstream the Delaware statutory trust and then ultimately the REIT ownership. We'll do a quick pass through just what Delaware statutory trusts are. If this is new content for you, would very much encourage you to visit our website. We have an abundance of resources available that will dive deeper into explaining and then illustrating scenarios in which Delaware statutory trusts are used in 1031 exchanges. We'll talk about the real estate investment trust structure, how one can use those tax-deferred exchange dollars to ultimately have REIT ownership, the profiles of property owners for whom this is an option that should be considered, and then an illustrative example as well as some additional educational resources that we can walk through as well. As Jeff mentioned, our firm, Real Estate Transition Solutions, is a real estate advisory firm that really focuses on serving property owners who are in what we consider to be the third to fourth quarter transition as it relates to owning and managing investment real estate. So commonly, our client profile whom we serve owns real estate that if they were to outright sell it would face significant tax consequences, but whether it's because of time management or regulatory pressure they're experiencing, or looking at the long-term prognosis and forecasts for the market in which they own, local or state of California, or maybe it's income and financial objectives. They're saying to themselves, I don't know that the property that I own today is the best fit for my objectives. And so we come alongside them to, one, discuss and determine their objectives, two, determine whether or not those properties are a fit, and then if not, develop a transition plan and help them execute that transition plan, in doing so on a tax-deferred basis whenever possible. Jeff mentioned we're headquartered up in Seattle, Washington, Kirkland specifically, which is very much true, and we have offices throughout the West Coast, Portland, San Francisco, and Orange County as well. What you see here is a quick snapshot of some of the key individuals on our team. Roger and myself are the two partners of the firm. Our chief marketing officer leads our team of marketing and education professionals that create all of the hopefully very helpful educational content you see available on our website, in our emails, in our articles. Monica Parikh leads our team of due diligence. There's 6 individuals on that team underwriting and evaluating any properties that we work with as a replacement property option. And then we have a bench of exchange advisors as well, myself being one of them, that work directly with property owners in our advisory process. So starting with the basics, Section 1031 of the tax code allows for individuals or entities that own investment real estate to sell property, and as long as they follow the necessary steps, take all of those sales proceeds and acquire replacement property without paying any tax. So when we talk about the tax that's typically due upon an investment property sale, we're referring to federal capital gain tax, federal depreciation recapture tax, state income tax, which California, as many of you know, has the highest state income tax in the country, as well as an often overlooked net investment income tax. That's an additional 3.8% tax. What that translates to is when selling property in California, you could be looking at a tax liability that is as high as 42.1% upon the sale of a property, which is a meaningful haircut to take after working hard to add value to a property, believe that property is appreciated, and then sell it and only realize a fraction of the sales proceeds that you likely expected. All of that can be deferred by performing a 1031 exchange. And when you're performing a 1031 exchange, you have to purchase what's called like-kind property. Now, that's not looking at the property type itself, but instead the IRS definition for like-kind is, does it have the same intent as to why it's owned? And all property held for business or investment purposes is like-kind with one another. So that opens up a lot of opportunities now to be able to reposition your, say, sales proceeds from a single-family rental or an apartment building into different markets, different property types, different ownership structures as well. One of those ownership structures is what's referred to as a Delaware statutory trust. And this is an area of focus and specialty of our firms, underwriting and evaluating and vetting these properties and working with property owners to determine whether it's a suitable replacement property option. What a Delaware statutory trust allows is for an individual to own a fractional interest, a percentage of large institutional quality properties. So think 30 to $200 million properties, Amazon fulfillment centers, 300-unit apartment buildings, portfolios of self-storage or senior housing or student housing, among all the major property type food groups. You can acquire a portion of one of those properties by investing in a Delaware statutory trust and have it actually be eligible for 1031 exchange purposes. Now, when you're investing in a Delaware statutory trust, the traditional structure allows for that property to be owned. You're receiving your percentage share of the rental income consistent with your percentage ownership of the property. And that property is typically managed on behalf of the investors for 5 to 7 years. Then it's sold, and at that time of sale, all of the sales proceeds go back to the investors, including any appreciation that the property realized. And each individual investor makes their own decision of what they want to do with their own sales proceeds. That's the traditional DST structure. There are a number of benefits. We're not going to unpack all of these associated with DSTs today. Very much would encourage you again to visit our website, our AOA partner hub, re-transition.com/AOA, where we have an abundance of content that focuses on these topics in Delaware statutory trust more specifically. But the ability to diversify, no management responsibility, higher quality property, enhancing income, estate planning, these are often the considerations that are motivating people to exchange into DSTs and why they have become such a popular replacement property option. Now, like any option, especially any investment option, there is no silver bullet. This is not a one-size-fits-all type scenario where a Delaware statutory trust makes sense for every owner profile out there. However, those that are focused on preservation of capital, tax deferral, stable, predictable income, and moderate appreciation, it can be a solution worth considering. There are some other considerations that need to be taken into account. They are inherently illiquid investments. All of the management decisions will be made by the sponsor, the firm that structures the trust and acquires and manages the property. And so those elements, including the fact that it is still very much a direct investment in real estate, subject to all of the risks that we know associated with real estate, like inflation and interest rates and natural disasters, regulatory, et cetera. Now, a REIT is a different structure than a Delaware statutory trust. Also a trust structure, but it has some key distinctions. And the REIT's history is much longer than that of the Delaware statutory trust. Delaware statutory trusts have been around since 2004. Real estate investment trusts, on the other hand, were approved by the IRS back in 65, but in the mid 1960s. So we have coming up on, say, 75 years of history with REITs. And what REITs allow for is a pass-through tax treatment, so preferential tax treatment in an ownership structure that allows investors to pool capital, acquire properties, and then not have the distributions from the income derived from those properties be taxed at the entity level, but instead flow straight through to the individual investors, and then they're taxed at their individual level, like an LLC or an S Corp or a Delaware statutory trust for that matter. The thought process behind the IRS designing and then approving the REIT structure is, let's allow these large properties to be purchased and invested in by the retail investors, individual investors, by allowing them to pool their capital. What happens in practice is a REIT will raise capital, and then it will purchase real estate, and it will own and manage that real estate, and then produce distributions for the investors, referred to as dividends. And the share price of the REIT will typically fluctuate based off of what's occurring with the value of the real estate in that portfolio. Now, perhaps the primary distinction between a real estate investment trust and a Delaware statutory trust is the fact that the REIT manager can actively buy and sell property within the portfolio. They're intended, for the most part, to be perpetual life entities. So they'll exist for years, if not decades, and have no finite life associated with them. So property is constantly being turned over when it makes sense to sell it, and purchased when it makes sense to buy new property. That in and of itself is what precludes the real estate investment trust in large part from being 1031 exchange eligible, because the real estate inside of it is not specifically identifiable. While the portfolio owns real estate, in many regards, you're investing in the REIT manager because they have that level of discretion. You contrast that to the Delaware statutory trust, where you are invested in specific properties, and once those properties are sold, all of the sales proceeds have to come back to the investors to make their own decisions, as opposed to reinvested on behalf of the investors. Now, REITs also typically own larger portfolios of real estate, whereas a Delaware statutory trust may own $50 to $200 million of real estate. And you can combine multiple DSTs together, of course, to create a portfolio. A REIT will commonly own anywhere from, say, $1 to $10 billion of real estate. So substantially larger portfolios, which is a reason why there's interest in many people having REIT ownership, for that diversification. But you cannot legally perform a 1031 exchange into a REIT. So the way in which you use 1031 exchange dollars to invest in a REIT is through what's called a 721 UpREIT. That sounds very complicated given the numbers and the letters here in the acronym, but really all it is an absorption of a property into a larger entity. So if you simplify the scenario, say you had two individuals that each owned a $1 million property, and they combined them together into an LLC. That LLC now owns two properties for $2 million in value. And if they approached a third individual who happened to also own a $1 million property, and they said, hey, Tom and Diana, we would like to absorb your property into our LLC, and instead of us giving you cash purchasing your property, we're going to give you a third of the membership interest in the LLC. So you'll now own a third of a $3 million portfolio instead of $1 million property outright. That absorption process is, in effect, the 721 UpREIT. And that's the way in which tax-deferred dollars can ultimately be reflected in REIT ownership, is by first exchanging into a Delaware statutory trust, importantly, an ownership structure that is very much eligible for 1031 exchanges. It qualifies. And then specifically, not just investing in any Delaware statutory trust, but a DST that is intended not to be sold to a third party down the road, but instead absorbed by a REIT, at which time then individuals' ownership converts effectively into REIT shares. Now, you might be asking yourself, well, why do we need that Delaware statutory trust step in the middle? And why can't we just go directly into a REIT? Well, the reality is most people do not own properties that a REIT would be interested in including in their portfolio. So this process allows you to sell your property to whomever will pay the most for it, and then exchange into a property that is actually targeted by that REIT. And that REIT is the one that structured the DST, so they know they want that property. Typically, what we're looking at is a 2-year hold period in the Delaware Statutory Trust to satisfy an IRS seasoning guidance, and then at that time, absorption up into the REIT. Once in the REIT, you can own those shares or operating partnership units as long as you please and be collecting dividend income and have tax deferral all throughout until you eventually decide either to sell shares and pay tax in whatever increment you please, or if you keep owning your REIT shares until you or your spouse pass away, California being a community property state, then all of your tax liability that you've deferred throughout these transactions is eliminated for your surviving spouse and then again for your beneficiaries. So benefits of the 721 UpREIT DSTs beyond that of the traditional DST. One, some people are attracted to the additional diversification, having exposure to a larger portfolio of real estate. Arguably, that may serve to reduce one's overall risk profile. Second benefit is some people don't like the thought of being in a 1031 exchange every 5 to 7 years when investing in traditional DSTs. So from a simplicity standpoint, it may make sense to be looking at the 721 UpREIT, if not for your initial exchange, maybe at some point down the road as you are getting older and older and have less appetite or interest in doing subsequent exchanges. That is a good segue into the next consideration, which is estate planning. We know that all these assets, all these investments that have deferred taxes in them will eventually get that step up in basis, which is the underlying goal of most of the clients we're working with, is keep pushing your tax liability into the future until someone passes away. But when you're invested in a traditional DST and receive a step up in basis, you may still have 2 or 3 years of hold period until there's a liquidity event. Contrast that to the 721 UpREIT DSTs. Once you have REIT ownership, you now have the ability to sell shares at your discretion. And so in turn, you don't have to necessarily wait that period of time between when that step up is realized and the liquidity. And some people value the liquidity for tax planning purposes as well. The ability to break up a sale into smaller pieces, almost like a seller-directed installment sale where you control the timing and you control the number of shares you sell and can then tax plan accordingly. Within the 721 UpREIT DST category, there are 2 subcategories worth knowing about. I'm going to just touch on these in brief. The first are those that we refer to as hardwired UpREITs. And importantly, these are DSTs that you are only investing in because you plan to go into the REIT. Every investor will be moved into the REIT. That's the strategy, and there's no deviations from it. There's also a category referred to as a hybrid UpREIT. Here we typically have a little bit longer ownership period in the DST itself, but also some optionality as to down the road, 3 to 4 years, say, whether or not you have to go into the REIT or can receive cash proceeds to either perform a subsequent exchange or pay tax. We know whenever evaluating a DST property, whether it is intended to be an UpREIT DST, and then if so, whether it's using one of these two structures here. Similar to the traditional DST, not every replacement property option is perfect for all profiles. The unique considerations around the 721 UpREIT DSTs really relate to once in the REIT. And it's worth noting that theoretically, the REIT managers can limit or restrict liquidity, the number of shares that will be bought and sold in a period of time. There's also always potential for a change in the tax code, and there are some unique estate planning considerations that you lose by being in a REIT as opposed to a Delaware statutory trust when someone passes. Lastly, it's very much worth noting that once you are in the REIT, you cannot exchange out of it. Your options at that point are either hold until you have a step up in basis or then sell shares before that, and in which case those individual share sales would be taxable. I touched on this before, but the profiles that this tends to be an option worth considering are really those individuals who want simplicity, they want liquidity, they want additional diversification, or they're starting to place an even greater emphasis on estate planning and the timeline associated with estate planning. If any of this is of interest to you, how do you go about evaluating and discovering 721 UpREIT DSTs? Well, best way to do so is by reaching out. Visit the AOA Partner Hub, re-transition.com/AOA. There you can schedule a consultation directly with one of our exchange advisors who would be happy to answer any questions that you have, share additional educational information, learn about your specific situation, talk about the pros and cons of different options that are available. And then ultimately, if there does appear to be an opportunity to work together, then help to develop that transition strategy and walk alongside of you throughout the execution of that strategy. As far as additional educational resources available, our California 1031 Exchange Guide, 7 Ways to Upgrade Your California Exchange, available on the homepage of our AOA Partner Hub. This is an excellent resource in terms of unpacking some of the strategies we see California property owners specifically employ around 1031 exchanges. For 1031 exchange basics, we have a 28-page, I believe, guide with abundance of resources as it relates to the rules, the mechanics, the timeline associated with 1031 exchanges. And then lastly, our guide to investing in Delaware statutory trusts. We want to unpack this topic in further detail. Webinars are a near weekly occurrence. We're particularly excited as the start of the year is coming up to launch our annual 2024 upcoming year market outlook. That's going to be a co-hosted presentation between myself and our Director of Due Diligence, Monica Parikh. Big picture trends, property types that we're focused on, markets that we're specifically interested in, information that we're going to be staying tuned to throughout the course of the year that's largely going to have a bearing on how 2024 is from an investment decision and investment management standpoint. And if anyone, again, has any specific questions or would like to have a conversation with one of the exchange advisors on our team, we are always happy to have a conversation with you. We can do so over the phone, via Zoom, in-person meeting, whatever is your preference. And if you visit the AOA Partner Hub, you can actually schedule time directly on the calendar of our exchange advisors. So if you're talking year end or forward looking into 2024, don't hesitate to reach out, 15 or 30 minutes, and we'll be at your disposal. So Jeff, that's all I have on my end. We have some frequently asked questions here that we can tackle, or if any questions came through from the attendees, happy to pivot that direction as well.
Great. Thank you so much. And I'm sure you're in the process of stopping the share part, and so we can see you nice and clear. There we go. All right. And yeah, thank you so much for that. one question that I have is when you're in the REIT,
Mhm.
what's the best strategy like when you're selling that off? Is there a strategy that can be used to avoid some of the capital gains, or it doesn't matter the quantity or
So,
the
so
dollar amount?
mitigate the capital gains, absolutely. Avoid, there's a couple options on the table here. One, the actual elimination of the tax liability is going to come by virtue of owning until someone dies, you or your spouse. And then you get that step up. In the interim, though, if someone wants to have liquidity, if they ever have a loss because, say, they sold some stock and it generated a loss, sell some REIT shares that year too and offset it. So it washes out. Loss carry forwards are great, but the sooner you use them, the more valuable they are to you, just from a present value standpoint. That's one. Second would be, if you take a larger sale, 500,000, a million, 5 million, any amount really beyond a couple $100,000, the tax due is going to push you into the highest brackets almost immediately, just because all those sales proceeds, all that gain is going to get considered in where you fall for marginal tax brackets. And if you break it up into smaller pieces, 25,000 a year, 50,000 a year, the rate applied to those funds could be 5% or more, even 8.8% lower. You're just going to pay a lower tax rate because you're not taking it all at once. And then one of the fortunate things with inflation, there are a few fortunate things, but one of them is that it has lifted our gifting allowance to each individual. I think we're at 17,000 or 18,000 now, and that's per individual to each individual. So if you're a married couple, you can gift either 34 or 36,000 to each recipient, 17 or 18 from each spouse. And what that means then is you can pass down to beneficiaries REIT shares. You can just gift them every year, and then they can sell them at their tax rate. Now, your basis does move over to them, so they would face tax consequences. But if they are, under 18 and don't have much by way of earned income, then they're going to be in a much lower tax rate than you are, and that can go into, say for instance, their college fund or whatever it might be. So those are a few of the strategies. It gives you some flexibility, which can be nice for all or a portion of your exchange.
Great. See, there's the CPA right there. Great. Thank you so much for that. And again, if you guys are watching on AOAUSA.com, there's that blue help bubble. You can click on that and get the question over to us. Of course, YouTube, Facebook, you know what to do. And we have Steve on YouTube. What are the unique considerations in the 721 when the investor passes?
So it's very easy to substantiate the value at which the step up goes to, because all of the REITs that we work with will post a monthly share price. These are what are referred to as net asset value REITs, public non-traded net asset value REITs. So they're not publicly traded from the standpoint of they're not listed on the New York Stock Exchange, but they're doing an appraisal methodology every month to post a net asset value, dividing it by the number of shares, and then that's the share price. When someone passes, they look at the most recent net asset value and say, say Jeff, you were to pass away and you own 10,000 shares and it was $5 a share, then they would clearly say, okay, that's $50,000 of ownership. His basis might be 20,000 or 15,000. So if he had sold those yesterday, then he would have paid a pretty hefty amount of tax associated with that 50,000 of ownership. But now the basis is adjusted up to 50,000, and that surviving spouse can begin selling those shares immediately after that's processed and not face any tax consequences. So very clean, very simple there. I mentioned losing a tax benefit by going into the UpREIT compared to the traditional DST for estate planning purposes. What that's in reference to is the fact that Delaware statutory trusts They qualify for what's referred to as a discount for lack of control or marketability, a DLOC. This is only relevant to people who have estate values over the federal estate tax exemption amount, which is currently $26 million. So that's a pretty high bar to meet there. But if you are over that, you might want to find ways to not increase the value of your estate, but actually lower the value for valuation purposes. We're not talking about the true fundamentals of the investments here. And when you're in the REIT, you do have that level of control over the timing and the marketability. So you can't take that discount to push your estate value down. Again, that's a small subset of people whom that's relevant for, but it is worth noting.
Right. And so for the person who's making a 1031 exchange and then they're contacting you, so you have these 721 UpREITs available for them. And then also people can go into regular the Delaware statutory trust, and then sometimes that is parlayed into an UpREIT.
Well, so the 721 UpREIT is a type of a DST.
Okay. Yeah.
There are DSTs that have that UpREIT functionality, and then most do not. And commonly what happens is if we're working with an exchanger, a property owner who's, let's say, 64 years old, we won't use 721 UpREIT DSTs out of the gates unless they need or want liquidity in the next few years. We'll typically be utilizing traditional DSTs, but then say they're 64 and their first portfolio of DSTs, those properties are selling in that 5 to 7 year window. So the next go around, they're in their early 70s on average. Maybe we pick up a 721 UpREIT in that set of exchanges, but maybe not. Maybe we do one more round, and then by the time they're in their latter 70s, late 70s, then we're starting to weight toward probably more conservative, more income producing properties, and utilizing the 721 UpREIT structure. And the goal maybe is by the time ultimately they're in their mid 80s, all of their funds are up in the REITs so that they don't have to do an exchange at 92 years old should they live that long, or so that their spouse doesn't have to wait 3 years to have a liquidity event if they were to pass away, or their children. So that there's often a migration as one ages. Unless you want liquidity in the near term, then we may use the 721s in those earlier years, what I like to refer to as the younger years, even though I think most of the people in those age ranges would contest that.
64, that's your prime, if you're a business person, you kind of have an advantage on everybody at that point.
Yep, lots of wisdom. Probably don't need to sleep as much at night too.
That's right.
The more productive working hours.
Yes. Great. And all right. Yeah, I don't see any. If you have a question, now is definitely the time to put it in. And what's another common question that you get? And we'll just try to.
We were asked regularly if you can exchange out of the REIT, and that's not allowable. We're asked often if you still have any of the depreciation once you're in the REIT, which you do. You'd still get tax sheltering for depreciation. We're asked about tax reporting, the differences between the two. And when you're up in the REIT, tax reporting often is done at a consolidated level, so it becomes a little bit simpler. Technically, you own a portion of the REIT and you don't have to file returns in each individual state, or at least it'll be done on behalf of the investors. The return difference comes up regularly. Is there one that has one structure or the other that has higher returns? And the returns available for traditional DSTs, that's heavily dependent on what property type we're talking about. And in large part, the same stands for the UpREITs, but I will say if history is any indication, you're more likely to be able to earn higher returns in the traditional DST than the UpREIT DST. The UpREIT DST especially because the REITs that we're talking about are often diversified REITs, multiple property types within them. It is very much like you're buying a mutual fund of real estate. And it's going to move up and down with how the market as a whole is doing, which can be a good thing because you're diversified, you're not putting all your eggs in one basket, but it's almost like buying the S&P, if you will, or an index fund, versus being tactical and saying, I want to invest in these specific industries, and not only that, but these specific companies within the industry.
Mm-hmm.
That's what the DST allows. And sometimes that ability to be tactical is appealing to exchangers, clients that we work with, because they say, hey, I still want to have some control. I want to decide what I'm investing in. And if I'm looking at a particular property type and I think, oh, I don't like the future of this property type, I don't want to be invested in it. And they want to have that discretion.
Right. Speaking of that, specifically, Jim on YouTube has this question in here. Are the properties in the DST REIT primarily office buildings?
Fortunately not.
Fortunately.
I mean, that's
especially right now, right?
In the REITs themselves, there will be some exposure to commercial office, although it is typically like the highest quality Class A, a core downtown or suburban office in markets that it makes sense to own office in. Which office is interesting because I do think, obviously, it's been a tumultuous time, to say the least, for office over the last few years, but it feels a little bit like we've found the floor, and there's some footing in office right now where I don't think there's as much downside risk moving forward as there was a year ago, or at least uncertainty. There's still going to be a lot of debt maturity that's going to force some sales. But when we talk about like office usage and occupancy levels, we're getting into the period of time, and by the end of next year, I think we'll be well through the period of time where a office building's lease rate might overstate its actual physical occupancy. So it's just a matter of time before those tenants don't renew those leases, and then all of a sudden there's true vacancy in that building. So we're getting close to kind of knowing maybe what the coming years are going to look like for office. And there will be some opportunities there too. I mean, remember that value is created in the differences of, you know, going from a lower value to a higher value with income along the way. And if you're buying at a particularly low price point, you don't need the values to recover to pre-COVID levels in order to make money on them, as long as you bought well enough low. So some office, but largely we're talking multifamily, industrial, medical office, storage, some retail, but that retail is typically going to be like grocery anchored outdoor shopping centers, not malls, not traditional, certainly not indoor malls. Those are many of the property types that we're seeing within it. We don't see a lot of student housing, senior housing, hospitality in the REITs, but if someone has an interest in investing in those property types, we work extensively with them in the Delaware statutory trusts.
Right. And then he also followed up with this: is in what geographic areas are the buildings located? So where are you guys more likely to be taking on these investments?
You know, again, for the REITs, pretty diversified. So you're going to see throughout all four corners of the United States, mainland, lower 48 here, with concentrations in denser areas too. Not a lot of tertiary market exposure. I'd be surprised if we saw many, if any, properties in the REITs that were in, say, cities or metropolitan areas with less than 250,000 residents. There could be a retail property or two that would fall in that size market, but for the most part, larger markets. The DSTs, heavily property type dependent, again, multifamily, a lot of, we'll call it Nevada through Arizona, Texas, and east, up the mid-Atlantic then to about as far north as, we'll say, Maryland. We don't really venture further north than that, up into the true Northeast, largely because of taxes and due to the regulatory environment. And then some scattered Midwest properties as well, which And the statistics show the Midwest actually outperforming many of the other regions of the United States in terms of rent growth right now. And that's due to the fact that there wasn't the supply built there over the last couple of years.
Mm-hmm.
There's still very, very strong demand in the Mid-Atlantic and the Southeast and the true South, but they do need to deal with absorption of this new supply over the next probably year and a half or so. And then we will expect to see pretty handsome rent growth returning after that. So that's where we're looking at multifamily primarily. We don't really look at multifamily in Washington, Oregon, California, although most of our clients are exchanging out of those states. When we talk about, say, industrial, it's all about metropolitan centers, proximity to logistics corridors. So, Moreno Valley could be looked at. You could be looking at Sacramento. You could be looking at Reno. You could be looking at Fort Wayne, Indiana, Macon, Georgia. There's all these markets that are not necessarily big markets from a population standpoint, but are key from a logistics standpoint. Location to people, location to ports, location to transit corridors and hubs. Retail we'll look at in smaller markets because we're typically looking at corporate guaranteed properties like CVS's, Walgreens, Tractor Supplies, Kroger Groceries, et cetera. And those are usually portfolios. Storage, we prefer what we call Gen V vertical storage. So we're looking at denser suburban and urban areas for that because we frankly feel like there's a lot of garbage, single story drive up storage out there and it's too quick and easy to build. When we talk about hospitality, there we want to see more than one demand driver for that market. And we look at the 4 primary demand drivers being business travel, recreational travel, government travel, or a major university. And if we can find markets where we're hitting 2 or 3, or ideally all 4 of those, that's where we would prefer to focus. So that means probably no Orlando because it's so heavily weighted towards tourism with a little bit of business because conventions. But yes, Austin, Texas. Mm-hmm. Yes, Nashville, Tennessee. Yes, Denver. So that's kind of our scope and lens that we're looking at. And that's just to get us in the door of accepting the market. Once we look at a particular market and properties within it, then there's a full property level due diligence process that begins.
Great. Yeah. And you guys have a great video on that as well. You remember the name? I don't know if you remember the name of the title on that one, but that was a good one.
DST due diligence, what it is and why it's important.
There you go. So search that one up on our channel. It's great. JH on YouTube, what are the annual admin costs of managing the DST REIT?
Within the REIT itself, typically the REIT manager's compensation is going to be 1 to 1.25% of net asset value. And that's an asset management fee. It's just deducted before dividend distributions are made to the investors. We're not compensated on an ongoing basis.
So that's not annual. That's just when there's a that's
an annual figure, and then it is deducted from cash flow. So if you view it this way, if you had $1 million worth of REIT ownership, then you would be paying effectively $12,500 for asset management for your portion of ownership. You're not going to have to actually pay that. It's just built into the financials and it's deducted before then they distribute your 5% or 5.5% or 6% cash flow to you.
Gotcha. So it's cash flowing 4 to 6%.
Yeah.
Today, we won't say what it's going to do tomorrow. Or
for the REITs, 4 to 7, probably depending on which one we're talking about. We have one net lease retail REIT that I think is paying 6.82% right now. Many of them are in that 5 range though, 5.5.
There we go. All right, JH, thanks for those questions. And one other thing, just a comment that Jim had or a concern is just back to that office building. He's like, geez, something like San Francisco, where it's only 50% occupancy. Obviously, you're just going to avoid that area like everybody else is. Yep. And unfortunate too, that people are leaving there in droves, and it's it's really a shame.
It is. It is.
Well, we appreciate your time, and you're so gracious. We had those technical difficulties, and you're just like,
Hey, I get it. No, it happens. Best of us.
so yeah, the best thing, just always start that thing back up and everything runs just fine. And it's such a head scratcher sometimes. Like, okay, well, what was it? And anyway, all of you too, thank you for your patience. And I hope you learned a lot from Austin. I like some of those things that, yeah, anyway, really appreciate you and the expertise that you bring to these live streams. So appreciate you.
Yep.
And happy Hanukkah, Merry Christmas. Enjoy the season here with your kids, right?
Yep. 2.5-year-old and a 10-month-old. So
Oh gosh.
they're getting excited. A lot of Christmas cookies consumed already this year.
Yeah. All right, everybody. Take care.
Thank you, Jeff. Bye-bye.
Thanks.